When it comes to dividend stocks, they are a long-term investment. If you invest in dividend companies with strong cash flows, no matter if the stock goes up or down in the weeks or months ahead, you earn a stable, growing dividend. Dividend growth stocks happen to be one of my favorite types of dividend stocks to invest in. And if you haven't seen my video on the power of compounding dividends, I will leave a link to that down in the description below. In the meantime, if you are looking for some solid dividend stocks trading at cheap valuations, I think you're really going to like what I have in store for you today. Hey everyone, Mark Rusin here, back for another video. And in today's video, we are going to be talking about 3 dividend stocks trading at cheap valuations. All 3 of these companies not only pay a reliable dividend that is well covered, but they pay a growing dividend, as 2 of the 3 dividend stocks are dividend aristocrats. But before we jump into the video, here's a quick word from today's sponsor. Today's video is sponsored by The Motley Fool. No matter where you're at in your investing journey, The Motley Fool has products and tools available to investors of all types. And right now, if you go to fool.com/Mark, you could sign up to receive their top 10 stocks to buy right now. With that being said, let's jump into our 3 cheap dividend stocks. With dividend stock number 1, Bank of America, stock ticker BAC. Bank of America currently has a stock price of $34.11, which equates to a market cap of $272 billion. Over the past 12 months, shares of BAC are down 30%. Bank of America is the second largest bank in the U.S. in terms of assets, trailing only JP Morgan Chase. They are also the most impacted by interest rates. As rates climb, they're able to increase what is called net interest income, which can be thought of as the difference between the interest they earn on loans and the interest they pay on savings accounts. Now you may be asking yourself, why would you be discussing a bank if we are headed for a recession? Great question, because regardless if they make more money on a loan, if the consumer is unable to pay back the loan, what's the point? Couple of reasons. Number 1, the recession has been forecasted for much of the latter half of 2022, making it one of the most predictable recessions on record. That is, assuming we get into one. Number 2, thus far, even with layoffs continuing to rise, high inflation, and rising interest rates, the data from consumers has held up. It has certainly softened over the past 6 months, and banks have already increased their reserves, preparing for anything. If we do fall into a recession and the consumer defaults start to uptick, well then Bank of America shares would not benefit as much from the rise in interest rates. However, given the current valuation we're seeing in shares of Bank of America, it seems as if much of this recession talk is already priced into the stock. After all, shares of BAC currently trade at just 9 times next year's earnings. That is single digits compared to a big bank that has been trading closer to 12 times over the past 5 years. In addition to a cheap valuation, the company also sports a growing dividend. The current annual dividend of 88 cents per share equates to a dividend yield of 2.7%. Management has increased this dividend for 9 consecutive years and counting, and the stock has a 5-year dividend growth rate of 13%. Now, a quick word of caution before you run out and buy shares of Bank of America. If you are watching this video prior to Friday, January 13th, just know that Bank of America will be releasing their latest earnings results on this day. So it might be smart to sit back and check out the latest earnings results and commentary from the management team before investing in Bank of America. The second cheap dividend stock is Medtronic plc, stock ticker MDT. Medtronic shares currently trade at $78.89, which equates to a market cap of $103 billion. Over the past 12 months, shares of MDT are down 25%. Medtronic is a global developer and manufacturer of medical devices, the largest to be exact. Regardless of whether the economy is up or down, medical needs do not go away, which means there's always going to be a need for medical devices, many of which are sold by Medtronic. However, as we saw a moment ago, shares of Medtronic are down over 25% over the past 12 months. So what has been going on? Given that Medtronic deals with actual products they sell, they have run into many of the same supply issues we have seen from a number of other companies. During the pandemic, we ran into supply shortages as factories across the globe were shut down, and then in 2021, companies overordered, trying to get ahead of these shortages. But now companies are stuck working out those supply chain issues, which is no different for a company like Medtronic. You will find that Medtronic's products are found all over hospital rooms across the country. And with the population continuing to age and healthcare becoming more accessible, it will only benefit someone like Medtronic. The company has generated more than $30 billion in annual sales over the past 12 months, which has helped fund a growing and reliable dividend. Medtronic is also a dividend aristocrat and close to becoming a dividend king, as they have increased their dividend for 45 consecutive years now. The company pays a dividend that yields 3.5%, and they have a 5-year CAGR of 8.1%. Looking at valuation, shares of MDT trade at just 14.5 times, which is well below their 5-year average of 19 times, suggesting shares look quite undervalued at current levels. The third cheap dividend stock on our list today happens to be a REIT, and that is Essex Property Trust, stock ticker ESS. Essex Property Trust currently trades at $214. They have a market cap of $14 billion. And over the past 12 months, shares of Essex are down nearly 40%. Essex is an apartment REIT, and although they are not the largest as that belongs to AVB and EQR shares, nonetheless, Essex is a major player in the apartment REIT space. However, they have a much different strategy than those larger REITs, who have a more diversified portfolio in terms of location. Essex is going all in on the West Coast. The company started back in 1971, and they are now the only public REIT dedicated solely to the West Coast. When you look at NOI, 82% of the company's NOI comes from the state of California alone. 42% of that comes from Southern California, and 40% comes from Northern California, with the remaining 18% dedicated to the Seattle region. The company maintains a portfolio of over 250 apartment communities that consist of roughly 62,000 apartment homes. Why the focus on the West Coast, you might ask? Well, these are areas that have strong economic growth, a strong jobs market, especially in the tech sectors in NorCal and within the LA and Orange County regions in Southern California. There's also supply issues out in these regions, which bodes well for the landlord, and the high cost of home ownership makes apartment homes much more realistic. The company's portfolio has generated strong cash flows for the company that has led to a growing dividend. The dividend yield currently sits at 4.2%, and they have been growing that dividend for 28 consecutive years, making them a dividend aristocrat. In terms of valuation, shares of ESS are trading at a very cheap valuation for those of you looking to go bargain hunting. This is a great stock to consider. ESS shares currently trade at just 15.7 times next year's AFFO estimates compared to a 5-year average of 22 times. So with these three stocks, all are trading at cheap valuations, all pay reliable dividends, and all of them pay growing dividends, 2 of them being dividend aristocrats. And with all 3, they come from different sectors. We went over a bank stock with Bank of America, a medical device company in the healthcare sector, and also a REIT, an apartment REIT with Essex Property Trust. Let me know down in the comments section if you own any of these stocks or if you're looking to buy any of these stocks in the near term. And also, if you enjoyed the video, make sure you hit that like button down below, subscribe to the channel, and we'll see you in the next video. Take care.